On Wall Street today, investors apparently liked what they heard from Yellen, sending stocks higher and pushing the S&P 500 to a new record high. The markets also got a boost from a batch of retail stocks after some better than expected earnings and outlooks. Investors and traders shrugged off some disappointing economic reports, a spike in first-time jobless claims last week, and a 1% dip in orders for big-ticket durable goods last month, both as a result of bad winter weather. The Dow rose 74 points, the Nasdaq added 26, touching a fresh 14-year high, and there's the S&P up 9 points, closing at a new record of 1854.29.
Joining us now with his perspective on the markets, our friend Hugh Johnson, Chairman and Chief Investment Officer at Hugh Johnson Advisors. Hugh, always good to see you.
My pleasure, Bill.
So the S&P sits at an all-time high tonight. Should it be?
Well, yeah, you can't argue with it. I think one of the reasons it should be is that when you take a look at just the experience of the last year plus, the returns that you've had from the stock market are so phenomenal, are so positive, and the returns from other asset classes, such as the bond market, haven't been very good. So as a result of that, that's obviously attracting a lot of investors to the equity markets. I think that's one of the reasons. They're just simply better returns. The other reason is when I take a look at, I crunch the numbers and I do the valuation metrics, Bill, I'll be honest with you, I think the market's fairly valued, and I don't think there's any good reason to believe that there's some reason that the current bull market economic cycle is going to end in 2014 and 15. So I think things look very, very positive. So I don't think there's any reason it shouldn't be here, and there's no reason it shouldn't go higher, significantly higher, perhaps.
So let me toss out the question about the Ukraine. You know, it seems like investors don't have to worry about the Federal Reserve too much. Fed Chair Yellen said she's going to stay the course. But what about all these headlines that investors are seeing about the Ukraine? How should they factor that in? Should they be worried about that?
Yeah, you always, Susie, you always have to worry about something, and you certainly have to worry about that. You have to worry about some of the things that Janet Yellen mentioned, which, of course, is what is the extent of the slowdown in the economy due just to the weather, or is there something more fundamental? And she's going to be working on trying to answer that question. So that's one worry. But the geopolitical situation should clearly be worried about it. Obviously, if it deteriorates, if what happens in the Ukraine deteriorates and it ends up in a confrontation between Russia and the Western world, including the United States, that's not good news, particularly when you think of Russia is responsible for about 12.5% of total global production of oil. So there are significant economic implications. So you watch that very carefully, cross your fingers, hope that it doesn't deteriorate further.
You're not alone in believing that the stock market has much more to go. A lot of analysts on Wall Street now are thinking that the S&P could hit 2,000 by the end of this year. But do you worry about some of these high flyers that we see these days, the Teslas, the Facebooks, the Netflix, Twitter, and that huge gain that it had after its IPO last year? Does that remind you of another time, maybe the 1990s? Are we getting frothy in a sector right now, do you think?
Yeah. I think, Bill, that's a great observation. And I think, Janet Yellen was asked the question if we're seeing speculation in different asset classes, particularly in equities. And I think she's pretty much said or implied that no, broadly speaking, we're not seeing a level of speculation or euphoria in the markets themselves. But there's clearly pockets of the market. You mentioned them. Tesla, for example, where you have extreme problems. Well, I have extreme problems with high valuations. And it does remind me of the late 1990s when we ran into problems. It's not, in my view, widespread enough yet to be overly concerned about it. But the Fed's going to watch it. I'm going to watch it. And every investor should watch it, because if it starts to broaden out and we get significant overvaluation, significant optimism in the markets, that's usually going to be a signal that it's time to, reduce your exposure to equities. But we're not there yet.
Very good. Hugh Johnson, Chairman and Chief Investment Officer at Hugh Johnson Advisors. Always good to see you. Thanks.
My pleasure.